All right. Good morning or good afternoon, traders. Today is Wednesday, the Fed day, December 10th, 2025. This is You've Got Options for Income Navigator. As we are waiting for the Fed to come out, and as expected, they are going to cut interest rates by 25 basis points. I think this is pretty much already baked in. The expectation of a rate cut is to the tune of about 90%. We can also look at, probabilities of future rates or rates going forward. So assuming they're going to cut today, right? This is a 90% probability. They really aren't expected to move until sometime in June, right? And then based on current Fed fund futures, there should be another potential rate cut sometime later next year, maybe at a September meeting. It's all going to depend on the tone of the Fed, and they're going to have a press conference at 2:30 Eastern. So if they're going to say that that they are pretty much done with today's cut, assuming they're going to cut, if they say that, hey, we're much closer to the end of this rate cut cycle than you think, I think the market's going to freak out a little bit, because the market is anticipating at least two more cuts sometime over the next year or so. So it's all really going to depend on their tone and their outlook on rates going forward. We always go through the same thing, right? On the Fed day, we look at the markets. The markets aren't doing anything, and then when the decision is out, we think that the initial move is what it's going to be. Sometimes market goes way up, sometimes market goes way down. But as we always say, you want to wait for the last trading hour, right? Wait for 3 o'clock Eastern time. This is where institutional money goes to work. They got to close out the books on the day, and this is where you are likely to see the real move or the reaction to today's event. Again, we're not in the business of predicting what's going to happen. We just look at the probabilities. We'll look at what the market data is telling us. They're going to cut, yes. Are they going to say that they're going to cut 2 or 3 more times next year? We don't know. If they do, I think the market's going to take this very well, and I think we could potentially run through previous all-time highs and move well above 7,000 on SPX. Looking at the volatility, I was just looking at how did the curve move over the last week. So these two lines, right? The blue line represents VIX futures term structure on December 3rd, which was 7 days ago. And this purple or blue line is the curve today. And as you can see, we're just looking at the shape of the curve, right? So near term VIX is lower than 60 days, 90 days, 120 days, which just tells us that the market is really not freaking out about anything in the near term. Sure, the market is anticipating more or higher volatility out in the future. Is that what's going to happen? We don't know, right? If things remain calm and nothing major happens, what's going to happen is 90-day will eventually become a 60-day VIX future contract, and then a 60-day will become a 30-day. So as you can see, right, we are anticipating higher volatility out in the future to come in over time, right? So the market is not freaking out about anything. I read a few things that came across earlier today that there are some major bearish bets going forward, and the market is anticipating a 10% correction out 90 days from now. I think these publications are out there just to grab us by our eyeballs in the best case, and I just don't see anything that the market is really anticipating anything, or if the market is even concerned about anything. As a matter of fact, I just saw, and looking at the tape or looking at the option order flow, it's kind of hard to read order flow for things like SPY, IWM, even Tesla, Apple, some of these super liquid names, because we don't know if we see a major bullish options trade that comes through, but we really don't know the full context of this trade. We don't know if whoever is doing this trade, if they're hedging against something, or is this a flat out, speculative bet. But I did see a trade in IWM for December 26th expiration, right? IWM is at around 252. Whoever they are, they bought the 265 strike call 2,500 times for 52 cents. And it was a sweep across multiple exchanges. So this is a textbook bullish bet. Are they anticipating a rally into the end of the year? Maybe. Are they shorting, or are they taking profits, or are they replacing their exposure in IWM by buying these out of the money calls? It's decent size too. I mean, dollar amount isn't that great. It's $130,000 bet, but when you see an order 2,500 contracts in one sweep, this is definitely institutional order flow. This is not mom and pop buying this for their IRA accounts. K Fall says, looking at the return on capital for the SPX OG bear trap. Okay, we'll talk about bear traps versus SPX iron condors. We're recently entered. Okay, it looks like for similar buying power requirement for the iron condor has a much higher return on capital. Can you talk about mixing lower return on capital trades with higher, and why it makes sense to continue the bear trap versus the iron condor yields twice as much at a time? I think it's a great question, and I also think that it is important to understand the context of what we are trying to accomplish. I think the best thing you can do is to look at the risk graph of either or both trades, compare them side by side, look at the T+0, identify where you're going to be in trouble, where you need to act on whatever the market is giving you. I'm going to switch over to OptionNet Explorer so that we can look at this risk graph and talk about it a little bit more. I think that there's no such thing as one trade is better than the other, right? I think that there's one trade that works maybe better than another trade in a certain market condition. And I'm going to share my Option Explorer so we could look at. This is a OG bear trap, and this is really a no-touch, kind of a very low maintenance trade, right? Where these are all puts. We put this trade on for a small credit up front. We do nothing until we hold this as close to expiration as possible. If we are outside of the structure, when I say structure, I mean this is the bear trap, right? This is where you have intrinsic value in the put debit spread, and almost most of the value of the put credit spread will be gone, right? So this is where you get the bonus. You get the benefit of put credit spread expiring near worthless and put debit spread having intrinsic or real value. So in this example, the bear trap would be somewhere below 70 or 67.60 and above 6,500, right, at expiration. And if you want to see what that would look like, right, with about 3 days until expiration, you can see if we're somewhere around, I don't know, 66.30 and 6,700, right, this is really the sweet spot, right? So this is where this trade makes a big chunk of its profit. And if we are outside of the structure, right, if all of the options that are part of this trade are out of the money, right, the most we can possibly make is the initial credit that we take up front, right? So this trade we put on 5 days ago, I put this on for a $200 credit. I know that if the underlying runs to the upside, I don't really have to worry about this trade at all because I can't lose any money on the upside. I would rather have the underlying go up, maybe go down a little bit, go back up, go down, so chop sideways, and then in the final week of trading, slowly creep inside of this structure or the bear trap, that would be ideal, but we can't plan for it, right? We don't know how the underlying is going to trade. So it kind of becomes like a binary event. Either we're going to be in the trap or outside of the trap. The real trouble in this trade is if we not just overshoot, but if we come down pretty fast inside of the trap with a lot of time until expiration, this is where this trade could really get into trouble. So, and to control risk, right, I always say that you need to be aware, right? Where are you in this trade as far as your running P&L goes? If I'm down between $500 or $600, I don't think I have the time or the credit available to start to pay the debits to fix this trade. Right? It's just a lot easier to take this trade off and move on to another trade. And that's part of the plan for this trade. So, what is the best condition for this trade? Well, the best condition for this trade is after we put this trade on, we're either higher or we're maybe down just a little bit, right? So you also want to look at what is the market doing, right? If you're putting this trade on, if you're putting this trade on after the market has made a huge run, right? And hindsight's easy, but if we were, somewhere up here and you're putting this trade on, is this the best time to put this trade on? It's not the worst time, but you have to be aware that after a big move to the upside, the probability or the odds of some kind of a reversion back to the mean is pretty high, right? So if we get a pullback, where's the 20-day, right? Or I use 21 EMA as the mean. So in this case, right, the 21 EMA was at 67.52, which is about 100 points lower than where the market is at this time, right? So if you look at where is the market, 67.52, right, about 100 points lower, right? If we revert back to the mean, well, I think it's going to be fine. What if we go instead of down to 21 EMA, what if we pull back to like a 50-day EMA? Right? Where's the 50-day? Well, the 50-day at the time, right, is at 66.40. Right? Where is 66.40? Well, 66.40 is going to be pretty close to my stop. Right? So you kind of want to understand the context. So you're saying, all right, if we pull back to the 50-day, I might get stopped out. So would I rather put this trade on, or would I rather do something slightly different? Right. And this is the other trade that you're talking about, K-Fall, right? We're talking about an iron condor. So instead of building the trap underneath the market price, right, we go out of the money on the call side, and maybe we sell a 15 wide or a 20 wide or whatever it is, right? We sell a call credit spread. So now this changes the risk graph quite a bit, right? We're giving up some of the potential profit inside of the trap, right? This is the difference between this green line. The green line represents the risk graph at expiration, and the blue line, right? This is the green line is the risk graph at expiration for the iron condor, and the blue line is the risk graph at expiration for the bear trap, right? Or this would be an all put condor, right? So we're giving up some of the potential profit inside of this area somewhere between 6750 down to about 6500, right? We're giving up some of the potential profit down here, but what are we gaining? We're gaining a potential profit, right, between 67.70 all the way to about 70.65 or so, right? So let me grab a pen so I could mark this on this chart, and maybe this is going to be a little bit easier to see, right? So we're picking up potential profit in this zone, and we are giving up right, we're gaining this zone here, but we're giving up profit down here, which is not a terrible exchange, right? We give up a little bit of profit down here, but we're gaining profit up here. But this is not an even exchange, because what else do you notice about the difference between these two risk graphs? Whereas before, right, with this blue line, we didn't have any risk to the upside. But if we're going to shift the profit, right, make the profit zone much wider, we're also picking up upside risk, right? So there's always an exchange. You want to understand the benefit, right, what you're gaining and what you're giving up for it. So when would you think is the best time to put this trade on? Right? You're right. In a market that's a little bit more neutral, right, where we're not so much concerned about upside risk, or even if the market, right, where we're looking at the price chart up here, right, and again, you can measure the overbought condition any way you like, right? There are many ways to do it. You can look at, the Bollinger Bands. If the Bollinger Bands are wide open, there's a pretty good chance that we're going to go into a time of volatility contraction where we might just knock out a range and the market isn't going to trend any further, right? The market may be due for consolidation. You can look at how far we are away in terms of average true ranges away from the mean. If we're trading at 3 ATR to the upside away from the 21 EMA, right? Very often we come back down or we chop sideways to burn some of the time off the clock to let the underlying moving average catch up to the price. And you can see that, again, many different ways to measure this. As you can see, right? I mean, would I call this, Bollinger Bands wide open? They kind of are, right, in relative terms, right? And there's a study. You can look at the width of the Bollinger Bands, and you can identify times where everything is in relative terms, right? Relative to the past, when is the Bollinger Band at its widest? It's a pretty good signal that we may be due for reversion back to the mean. Volatility may be contracting, right? The Bollinger Bands need to start to pinch in. And looking at what happened here, right? Again, this is hindsight trading. I'm not making the case that, but you can see very often after these expansions, we see some kind of price consolidation. And sure enough, we went down to the 50-day simple moving average. So there's a pretty good chance, and this is a great piece of software to do this with, right? You can go back and say, you know what? What if I initiated the OG bear trap somewhere around October 28th or October 29th? How would that work out with a pullback down into November 7th? Right, where I just said that if we were to initiate this trade somewhere up here, in my opinion, if we were to come down and test 50-day moving average, this trade might be very close to being stopped out. Now, if you're putting on this trade after the market, is X amount percent away from the underlying moving average, and I like to use that study as well, how far are we away from 21 EMA in the percentages terms, right? Because there are going to be times where the price is going to move away from the 21 EMA, and then we're going to either move back up towards the 21 EMA, or we're going to trade sideways and wait for the 21 EMA to catch up, right? We could correct in one of two ways, price or time. Price meaning we go the other way, or time correction, time-based correction is when we just consolidate after a move, we consolidate and wait for the moving averages to catch up. As you can see here, we did not consolidate. This was a price-based correction. We actually reverted and we headed back up. Right. So, but if we were to initiate, for example, if we identify somewhere down here a point where, you know what, we're probably due for a reversion trade, would I want to put on a trade that looks like this, where there is risk to the upside, risk of the market reversing and making a move the other way, and I get a run over to the upside? Right. So I'm not saying that one is better than the other. What I'm saying is there are times for one trade and then there are times for the other trade. And it's not me knowing or picking exact perfect timing to when to enter this trade. Everything is in context of what you think is happening and which trade would you think would work better given what the market is telling us. Right. So for right now, right, I put on this trade here, right, and we're not super stretched. We're coming back up to test. We're very close to all-time highs. I don't know how much more we have in the tank. Sure, we can potentially rally off the Fed announcement with the interest rates. We just don't know what's going to happen. So, given the market structure, I thought this was a pretty good idea to put on the trade that was neutral, right? And if we're able to break through the potential resistance at around 68.90, we're probably going to run to test most recent all-time highs at 69.20, and then we're just way too close to this round number of 7,000 on SPX not to make a run for it towards end of the year. Now, again, I'm not anticipating with this trade. I just think that given what's happening in the market right now, I wouldn't want to put on the trade that has a ton of upside risk, because I think that the risk may be to the upside right now. Right. And if something changes, if I'm wrong, I'm not going to say, well, my due diligence was right. I'm right. Market is wrong. I'm going to, hold this until. No. If I'm wrong and the market rolls over and dies on me, I know that if I'm down $500, $600 on this trade, it's time to take this trade off. Forget about what I think is going to happen. If I'm right, this trade is going to pay us. We don't need to do anything else. If I'm wrong and the market heads the other way, I know that once I reach, $500, $600, whatever your stop in dollar terms is, it's time to get out. Right. And I know that sometimes, we look at the trade and say, well, why would I stop out here? We're kind of in the middle of this bear trap, and it looks great. We could potentially make all this money, blah 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 blah. But the bottom line is that when we took this trade, right, we're looking for bullish to neutral markets, and if we put this trade on and 3 days later the market is down 3.5%. Well, maybe taking a neutral to bullish trade isn't the right thing to do. So we don't need, or we shouldn't be in this trade. Sure, you can hedge this, and we talked about this, last week or the week before, but there's just not enough credit. It's too much work for maybe a break-even trade in the end. You're just going to spend too much time defending this trade. You're going to spend too much psychological capital, and I just don't think. I think that it's just easier to use a stop, identify where and when you would stop, and if the stop hits, it is what it is. It's time to get out. But I do like the iron condor trade. It just, I would need slightly different market condition. The best market condition for the iron condor, if you don't mind taking on some of the upside risk, is when you're anticipating market to be up slightly or down slightly, right? But if the market looks like it's just consolidating and it's just building up the energy to potentially, make a run to the upside, the iron condor may be a slightly more difficult trade to hold because, again, adjusting iron condors. And we had this conversation yesterday. Someone was asking about, an iron condor that gets tested to the upside, right? Would I roll? Would I roll the tested side? Would I, fix the tested side and pay for the adjustment by rolling the untested side? All of that is just, it becomes too much. It's a lot easier to deal with short options naked, but if we're talking about defined risk trades, even though our risk is defined, we should also know when is the market telling us that we were wrong, and the best defense is get out of the way. Let the market do. And you know what? There may be times where you get stopped out and the market just will reverse and go back the other way. And if you fall for it, if you say, well, next time this happens, I'm not stopping out, you're just training yourself to potentially, not follow your plan, break your rules. And the next time the market goes down, you don't stop out because you anticipate a reversal just like last time. And if it doesn't happen and instead the market goes down another 4 standard deviations against you, you will take one trade that should have been a regular stop to a trade that will take you a long time to recover from. All right, let's take a look at. I'm gonna go through positions that I have on in the triple income trade. And they're all kind of different variations. I mean, they all have one thing in common, right? That we're selling premium, we're trying to capture that premium. We may be getting assignments if we're anticipating to collect dividends. If we do get assigned, we're anticipating to sell covered calls to potentially capture more premium. And then eventually, if we get called away, right, we'll realize a capital gain. So it's kind of like actually more than triple income, it's quadruple income if we consider the put credits that we're collecting, the call credits, the dividends, that's 3, and then potential capital gains, that would be 4. But I have several positions on. We can kind of see, and I shared this before. If you guys are using the spreadsheet, I find it very useful. This would be a poor man's covered call, right? I am long a in the money call at 40 strike. This is MAGS, right? This is the Magnificent 7 ETF. And this one has 401 days until expiration. And then I am short a December 19th call at a 70 strike with 9 days to go. So this trade is working out pretty well for now. And then once this short call is going to have just a couple of days left until expiration, I plan on either expiring or maybe if I can just close it for maybe 5 cents or less, I will close it and roll to the next expiration or whatever the next closest to 30-day expiration is, and just continue to move that way until I collect enough premiums where I will get to pay off a big chunk of the intrinsic value that I paid for with the long leg of this trade. I have a couple of TLT positions on. So this is the smaller position. This is just the one lot. I am now short the 89 put with 21 days until expiration. The 89 put is now in the money. It looks like TLT is trading at $88.36, which is fine. The plan for this trade is to get assigned. Would like to get the dividends that TLT offers. I think The dividend yield right now is 3.8%. So not as sexy as it was before, where we were, four and change, closer to five, right? But as rates came down, so did the yield. So 3.8% yield. If we get assigned, great. If you don't want to deal with assignment, if this continues lower or if it's trading sideways and if the 89 put continues to stay in the money, we can just, instead of getting assigned, we can just roll and end the money put. And this would be a synthetic covered call position where we're just going to continue to collect premiums from the in the money puts, the extrinsic value. We're going to continue to harvest extrinsic value. We just are not going to get any dividends because in order to get the dividends, you have to own shares of the underlying. This is the other TLT position. This is where there is a long stock position, 500 shares that were assigned last year, end of the year, at 90. I've had a number of dividends paid, plus I was selling covered strangle around this position. So as you can see, this one has now 21 days until expiration. I am short the 87 put and a 92 call. Right, so they're both out of the money right now with 21 days to go. If we're below 87, I may consider taking on another 500 shares, or maybe I will just roll an in the money put, and I will also sell another call against the stock that was put back in December of last year. All right, it's a very easy trade to manage, and we can talk about how well this trade did, everything else being equal. Right, you can say, well, this doesn't even beat S&P because, I don't know, S&P is up, what, maybe 18% or whatever it is year to date, right? And that's a fair point. But P&L volatility of this trade wasn't as great as S&P was. And even though S&P is up 18%, let's not forget, at some point this year, S&P was also down almost 20% or 15 or 18%. Right, so this trade was never down as much. It was pretty steady, right? Also, this 12% ROI is cash on cash, assuming you paid for the 500 shares of TLT, right? 500 shares times 90 is $45,000. Now, if you have utilized some leverage, right, that portfolio margin gives us, or if you have utilized leverage, there are other ways we could have played this, right? Instead of taking long stock, we could have just replaced it. We talk about this enough, right? Replace the long stock position. We just wouldn't get the dividend. So keep that in mind. And instead of holding the shares, we could have replaced the stock with a synthetic long position, and cash that we would have not used to buy the shares, we could have bought treasury bills with it. So we wouldn't get the dividend, but we would get the interest from treasury bills. And if you are trading this in a portfolio margin account where it takes just a small fraction of this $45,000 to hold on to the 500 shares of TLT, this trade is actually close to 100% return on requirement to hold the share. So if you wanted to utilize leverage a little bit and maybe go 2x leverage, right? You could have done, instead of 500 shares, you could have bought, 1,000 shares. And again, cash on cash, this number is not super attractive, but if you are using a little bit, you don't have to go, crazy with the leverage, but if you're using a little bit of leverage, there is no reason why you can't, get as high as maybe 30% return on your investment in this very simple, very steady, very boring trade, right? This is a covered strangle in TLT. If you wanted to follow this trade along, All of the detail of this trade is on Discord. You can go to the alerts channel and type in TLT, or the trade ID for this trade is it is 3077. Okay, so you can look at that, and if you have any questions, it's pretty simple, pretty straightforward. But if something isn't clear, don't hesitate to ask questions. Let's look at the next one is Altria. Altria Group. I think that's what the company is. Time Merchant says, I've been considering using TLT trade in an IRA. Yeah, I think it's decent. One thing I will say about, IRA trading, guys, I say this time and time again, not to discourage you, but to kind of warn you that, a lot of trades that we do, they do really well when the market is calm, when the market is steady, but things could get crazy, right? If you are able to sell options naked in your IRA, and if you're using, super high beta names because that's where all the fat, juicy premiums are, right? If the market goes through a correction period and your underlying that was everybody's favorite, and now it isn't, and that underlying goes down 60%, and you lose 50% of your IRA, well, here's the problem. You can replenish your IRA, right? There's limitations. You could only put so much money in your IRA each year. So if you lose 60% in your IRA and you could only contribute, right, 75 or 8,000 or whatever that number is for next year, well, you just put yourself in a really difficult spot. So if you are going to do anything in an IRA, just think about, right, where is your stop? At what point do you cut your losses if you need to, just to preserve? Because again, IRA, unlike a regular account where you can just make a deposit, and if you needed to put some money in for the next 6 months to kind of weather the storm, you can't do that in an IRA, right? So don't put yourself in crazy situations when it comes to IRA accounts. But I think TLT is one of those, or SPY for the long term. I think those are fine. I wouldn't want to see anybody, use things like anybody remember Peloton, or these high flying stocks where everybody loves them. They got all the momentum, and then when that momentum goes away, so does your IRA. So please be careful. Altria, right? So I got an assignment on the 62 half puts. So now I'm long 100 shares at 62 and a half. I still have a 57 and a half short put with 9 days to go, which is out of the money. I think it's trading for like 20 cents. I sold it for 87 cents. So I would consider buying to close this 57 half for 20 cents or whatever it's trading for right now, and then going out whatever is closest to 30 days. And I could stay on the same 57 half. I looked at something like that earlier today, and it looks like, let's see. Let's see. Let me switch over to the OptionNet Explorer, and we'll look at this. So this is the Altria trade. This is what it looks like. Right. It's down. It's down because the underlying has gone down 1.3 standard deviations. We were a sign on stock, so we're long stock, we're short a put, and we're short a covered call against the stock. The short put is the next thing that's going to expire, which is 9 days from now. So what I considered doing was to buy to close the 57 half in December 19th expiration cycle, and then going out to January 16th with 37 days, and selling to open the 57.5. Right, so 57.5 in January is going for just over $1. So I would collect $1 here. I would spend about 20 cents to close out the put in December expiration cycle. So maybe I would net about 80-cent net credit here. And as you can see, this one's going for about 80, maybe 82 cents, maybe 80 cents I would get on that roll. And this would put me in a position that looks like this. Right? And this is a true shape of a covered strangle where I am short out of the money put, I am long stock, and I am short out of the money call. So what happens is from here, by the end of January, I'm either selling my 100 shares at a higher price for a capital gain, and the out of the money put is going away, it's going to expire, or if the underlying is lower, the short covered call is going to expire and I'm going to buy more stock at a lower price. So I will then have not one, but 200 shares at an adjusted cost basis, whatever that would be. Right. So covered strangle is kind of a way to, if you wanted to buy low, sell high, right, and make it automated. And then while you're waiting, I like this underlying, not because I like the company. I think smoking is terrible and the product that they're making is terrible, but they have the dividend yield right now is about, it is about 7%. 7% dividend yield. So while we're waiting for this to play out, we'll get the dividend. If the underlying is higher, we get called away, we'll realize a capital gain. If the underlying is lower, then we'll buy more shares to potentially collect more dividends. And then I would sell another covered call and potentially sell another put to potentially take more shares. Again, you have to plan for this all ahead of time, right? If your max size for this trade was 100 shares, then selling another out of the money put puts you at an obligation that you may have to either take a loss or you would have to take the shares at a lower price. If this was not part of your plan, right, to take more shares at a lower price, you're kind of trading without a plan. So if you say, you know what, I'm going to do this trade maybe in 3 tranches. I'm going to start with 100 shares. If I get assigned, I'll do a covered strangle, assuming that I might get assigned, and I will take one more lot of 100 shares. So now you will have 200 shares, and then you'll do another covered strangle, right? Because you were going to buy up to 300 shares in 100 share round lots, right? So hopefully this makes sense. So what I am going to do, I am going to buy to close the 57.5 in December, and I'm going to sell to open 57.5 in January for, it's going for 48, 43.50. I'm going to enter this trade and see if I can possibly get it for 84 cents. And there is nothing for 84 cents. So I'm going to go down to 83 cents and then I'll go down to 82 cents. And then, we'll see where the market is and we'll just keep on going. So I'm at 83 cents with no fill, which is fine, right? I start at a higher price because we saw the mid price for this was 83.5, right? We can't do 83.5. So now the mid is at 81.5. Probably not going to get it. So I'll go to 81 cents to see if there's anybody there to open that door for me, and done, right? So I just rolled this put for 81 cent credit. And now this is what my position looks like, right? So, and this software will figure out the cost basis. This is a true break even, assuming all of the premiums that I have collected so far, right? So if I get called out of my position at 60, right? This is where I'm short. I'm short a 60 call in January for 48 cents. So if I get called away, right, I will have gained, or I'll have a capital gain of about $118 or something like that. And then I need to see if there were any dividends. There were not. I think there is a dividend coming at the end of December. So maybe if I get called away, if I get called away in January, maybe I will have one dividend that's going to lower my cost basis a little bit more. Right. So that's kind of the plan for this trade. Keep it simple. Don't overcomplicate things, and use a spreadsheet. Keep track of your premiums you're collecting, or debits if you're rolling for a debit and whatnot, so that at any given time you have a pretty good idea, where you are in the trade. This trade was adjusted yesterday, right? So this is the proxy for Ethereum. The price has come down quite a bit. We started this trade right at the money when it was trading at around 34. It is currently trading for 25.71. So we had rolled the puts down a few times, and now I was able to consolidate. So I have two tranches. I had one tranche at 34, which was the original strike price, and then I had another tranche at 22. And then I was able to close out this short 22 put. You can see I originally sold it for $2.10, and then I had bought it back for 24 cents. And then I just consolidated both at 30, right? So I rolled 34 and 22 to 30 and out to 37 days. So now I have two naked puts at a 30. Oh, sorry, my fault. Let me change the screen. Thank you. Um, this was the original 34 put. I rolled it down a couple of times. Then I sold another 22 put. This 22 put I sold for 210, bought it back for 24 cents, and then I consolidated both 34. You can see here the dates. So I bought these. I bought the 34 for a loss, and I bought back the 22 for a gain, right? Net loss of about $80. And then I consolidated both. I sold two puts at 30, strike with 37 days. And then I sold a 30 call, right? So now I'm in a position that kind of looks like it looks like an out of the money short straddle at 30, but I'm short two puts and I'm short one call. So it's slightly off balance. Right. So the best case scenario over the next 37 days, we're somewhere around 30. And that's where this trade is going to make the most profit. I can also, this switching back and forth. Hopefully I don't forget to switch back, but I want to show you what this trade looks like right now. And it may sound confusing with all this rolling and going up and down. But in reality, it's, again, if you have a visual tool to see what your trade looks like, and if you're keeping a spreadsheet, which will give you your true P&L, you can see that, I mean, it's not the easiest trade to hold, so to speak, but you can see how much we've come down from where we initiated this trade, right? And looks like maybe this downtrend is now starting to change, right? We had a bullish cross in MACD, RSI is over 50. So maybe things are turning a little bit. And again, yes, I have introduced upside risk, but this upside risk is, like 50% away from where this underlying is trading right now. And as you can see, based on what is currently being priced in, right, this darker gray area is a one standard deviation. So if the underlying moves somewhere within a one standard deviation to the upside by January expiration, right, this could potentially put this trade in a really good spot, right, somewhere up here around. Even if we overshoot the short strike, which is at 30, even if we are above 30 and that short call goes in the money, I have two short puts at 30. So those two short puts will make up some of that loss of the in the money short call at a 30 strike. So it's not that big a deal. Just because your option goes in the money, it's not game over, because I know that when we have an option that goes in the money, it sounds like the scariest thing in the world, but if you have a way to see what your risk graph, where your P&L today is and what it looks like, the real trouble for this trade is if, we walk in one day and, the underlying is trading at 40 or 45, right? Because even though we have two short puts, this one short call is really where the trouble is. And now we need to figure out how to fix this position, because, to the upside, it's just going to get worse. But anything between 30 and I would say maybe 35, it's okay, right? We'll make less, right? Some of that profit will be eaten away from that in the money short call, but it's fine, right? Because we can always close this trade and reset, put on a new trade if we still think that the underlying is bullish or whatever. All right, let's keep moving. We're going to go back to the spreadsheet. And now we have, this is the home builder ETF. We are short 102 put with 21 days until expiration. This one's trading at 105. I think I looked at the home builders chart and it looked pretty decent. This short put is in no trouble in any way, shape, or form. XHB is, yeah, it's just, it's not screaming buy right now, but it's definitely looking a little bit better now than it did before. So I'm just going to let this run out, and I think it's a fairly decent idea if you wanted to get a sign at 102. But for this trade, I'm not going to take an assignment. I would consider rolling an in the money put, because I don't think there's any reason to own the shares. Dividend yield is just a little over than half of 1%. So I wouldn't want to tie up settled cash to hold shares of this ETF. I would rather roll an in the money put, which only takes up a couple of $100 to hold. And if I wanted to generate yield on the cash that isn't being used, right, that settled cash that's just kind of idling, I would buy a T-bill and get 3.8% on it, right? Something like that. So there are always two things. Either I'm taking the assignment because I'm looking for that dividend payment, but if the underlying doesn't have a good dividend yield, then why would I take an assignment on a short naked put only to sell a covered call where I can just roll and in the money short put, which is identical to a covered call risk graph, right? We talked about this before. XLF financials are looking pretty good. I actually looked at the chart of Goldman Sachs. I looked at the chart of Bank of America, Wells Fargo, a few others. They all look really good. JP Morgan didn't look as exciting, but financials are looking pretty strong. I'm not sure if the market is rotating towards financials because we think they're going to make more money in a lower rates environment. I would think it's the other way, right? The banks make more when rates go up. But maybe overall, the economy is improving, and As the money starts to rotate toward riskier assets, maybe the banks are not a terrible place to look for some potential trades. Goldman Sachs is one of those that I think it's already trading not only at an all-time high, it's also the conditions are super overbought and blah, blah, and I can give you a million reasons why it's a terrible idea to go long Goldman Sachs, and for that specific reason or two, Goldman Sachs is going to continue to move higher, right? Because everybody thinks it's overbought, because everybody's looking for a pullback, and this one could just, when stocks go to all-time highs, right? There's no supply up there, right? Why would anybody want to sell Goldman Sachs? If you're a professional money manager, would you want to unload your position in Goldman Sachs and then having to explain to your clients why you're not in Goldman Sachs as the stock continues to push through all-time highs every day? You don't, right? So there's no supply and demand is up there. So that kind of creates this vacuum where Goldman Sachs continues higher. A few others look good as well. So I would probably consider doing Goldman Sachs trades on any pullback. I think that Goldman Sachs, some kind of slightly out of the money call butterfly would probably make sense too. But this XLF looks pretty decent. 21 days to go. We'll see what happens. I also don't think I want to get assigned on XLF. Let me just double check to see. Nah, the dividend yield is 1.3%. So if I can get a higher yield parking this cash in a T-bill and just deal with an in-the-money short put, that is what I want to do. The two trades that are kind of troubled, I would say, but I think longer term they will work out, right? We have the URA, the 50 put, that is in the money with 23 days to go. I think that's going to be just fine. And CRWV, right, that is in the money. You need to check how much extrinsic value it still has. Once extrinsic value kind of runs dry, there's a risk of getting assigned. I looked at it over the weekend. I think somebody asked. I posted my thoughts on the chart. If you want to go on to on Discord and just type CRWV, you'll probably get it. One of the top search results will be with my commentary on it. I think longer term, it's a very promising company. They do have some near-term potential things that they will need to deliver on, but if they can pull it off, I think this one has a lot more room to the upside. So for right now, with this 110 call, kind of sucks, right? It's not fun. Again, when the underlying goes and or your naked puts go in the money, it feels like the world is ending, but it isn't, right? You just need to understand the context. You need to know your time frame and let everything else kind of do what it will. Those are the positions that I am holding. I'm looking for a few more hedged income trades. For some reason, Option Explorer, the software that I use, does not have the contracts that they have previously had listed, which is like super annoying. So the risk graphs look all kinds of goofy. I'm emailing back and forth with their support to see if this issue gets resolved. It would really suck if it doesn't get resolved. And just I don't like having positions on without being able to visually see where these trades are, and if I plan on making adjustments. If I can't see it, it just makes it a little bit more difficult. All right, I think that we're going to stop here. It looks like, what's the news? The news is they cut the rates. Volatility down. Initial move right now is to the upside, or at least that's what it looks like. Right, it looks like we are already at the first target for open range breakout study, which is up here. But again, guys, initial move typically gets faded. I'm not saying this is what's going to happen. I'm just saying that the initial reaction sometimes is just a trap, right? We're going to go up, we're going to go down, we're going to go up and down. At 2:30, right? Jerome Powell is going to deliver his remarks. The market's going to be very carefully listening to their projections and what they think about the economy, and kind of read between the lines to see where they may go with the rates going forward. And then I would look at the market at 3 o'clock, 3:15, 3:30 for more clear direction in which we may be moving forward. All right. So with that said, guys, I'm going to cut off here. Have a good rest of your day. I'll catch you guys on Discord. If you have any questions, let me know. I'll be back on Friday. Take care, everybody. Bye.